So we've seen some positive data over the last couple of months in that inflation is coming down and seems to be consistently coming down. So that will help rebuild real incomes and so support consumption. We're also seeing, some countries will have some fiscal support as well this year. And we've seen a much stronger position from the US in particular since our last update 2 months ago.
When it comes to the U.S., a sizable upgrade from the last report, up 0.6%. Where is that strength coming from?
So we've seen positive news in the US. We're seeing inflation coming down now, but we're not seeing a big cost in terms of the labour market there. The labour market remains strong in the US. So growth is looking stronger and inflation coming down. So you'll see a rebuilding of real incomes there in the US, and that will support consumption growth.
When you talk about inflation, I think it is interesting to note that inflation has actually fallen quite rapidly, faster than many analysts had been anticipating, even the OECD. Would you say that the final mile of fighting inflation is going to be the hardest?
Yes, I mean, you're right. We've seen inflation coming down faster than many people, including us, expected. But the job certainly isn't done on inflation. We still see inflation too high. It's still causing pain for people and for businesses. There's still further way to go. Our central projection do expect it to come down, including in the US to target levels. But that final, as you say, the final mile is tricky, and we need to see it return all the way to targets.
Messaging from central banks in the last couple of weeks has been one of cautiousness. The market, of course, is pushing central banks to be more dovish when it comes to the possibility of rate cuts throughout the course of 2024. But we've heard from various senior central bankers saying that they just want to be a bit more cautious, wait and see the data before they're convinced that inflation is going to be sustainably back at those price stability targets. Do you think that central banks are doing the right thing by being cautious, or is there a risk of them staying in too tight or too restrictive territory for too long?
We think they're right to be cautious. I mean, inflation's been incredibly painful and it needs to be durably brought back to targets. And we're not there yet, and there's still some way to go. And you can see in services price inflation, in the labour markets, there is still some underpinning support for inflation there. So central banks are right not to loosen too quickly and to keep a restrictive stance until they're more confident that inflation's going to make it to those targets. Obviously, the risks are balanced on both sides, and that's why they're right to keep an eye on the data and to respond as they see further disinflation over the coming period.
Do you see the disruption on the shipping in Red Sea as having a lasting impact on inflationary numbers throughout the course of 2024? Is it something you're watching closely?
It's something we're watching closely. We don't yet expect there to be a sort of a lasting increase in terms of inflation. But of course, should this disruption continue, we have seen an increase in shipping prices. If that were to continue for an extended period, then that would feed through into consumer price inflation. But at the moment, we don't anticipate that to be the case. And in our central scenario, we're not anticipating a long-term impact on inflation from that increase in shipping costs.
Well, one just other perspective to think about, perhaps later on this year, we have U.S. elections coming up, and former President Trump seems to be the front runner for the Republican Party. He has talked about the possibility of bringing back tariffs, introducing tariffs on the European continent, introducing tariffs of more than 50% on some Chinese goods. Have you done any work as to the impact that those tariffs would have, both on inflation, but also when it comes to the global economy, should we go down that route?
We don't do analysis of sort of forward-looking positions of different potential policies. What we do is a lot of work on the impacts of trade, and that underpins our position that a free and fair trading system is to the benefit of people around the world, including some of the poorest.
Let me just turn back and ask you about some of the more the geographic splits that you flagged in your growth report today. One of the numbers that, again, stood out to me was your assessment of the Chinese economy. And in fact, you don't see it growing very strong despite some of the fiscal support that has come through. What do you think is going on there, and what needs to be done for China to get back to that 5% growth level?
So you're right. We have our growth projection just under 5% for China for the next couple of years. That is a marked difference from what we'd seen in the period from 2000, where China was growing between 8 and 10% annually up until the COVID pandemic. There's a number of risks the Chinese economy is a number of challenges the Chinese economy is grappling with. So the real estate sector there is going through a transition. There's a lot of excess capacity, and that needs to work its way through. We're also seeing a fall in foreign direct investment in the Chinese economy. And again, that will reduce growth in the medium and longer term. So there's a number of challenges facing the Chinese economy, and that's why we've lowered we have a relatively low growth outlook compared to what it has been in the past. I mean, it's also worth remembering, though, that China, the economy has grown an awful lot over the last 20, 25 years. And so, it was never expected to continue with these 8 to 10% annual growth rates as it moved towards other economies.